Hello and welcome to BQ Prime. Joining us today is Mr. Venkatraman Narayanan. He's the CFO of Happiest Minds, and Joseph Anantharaju. He's the vice chairman of the company. They're speaking to us a day after the company declared its Q1 numbers, where profit and revenue saw a marginal uptick sequentially. But in constant currency terms, the revenue was up 13.8% year on year, with margins in excess of 25%. Gentlemen, welcome to BQ Prime.
Thank you.
Thank you.
Yeah, so my first question is to you, Joseph. Just given the quarter, the way it has been for the rest of the IT pack, you are looking like an outlier. So can you take us through the earnings this quarter, some hits and misses that have happened in the first quarter?
So if you look at the results that we've been able to declare, which is a 4.7% quarter-on-quarter growth in total income, Tushar, this has been driven by a mixture of account mining and new logos. We had 18 new logos that we were able to add during the quarter. And this is on top of the 16 or 17 new logos that we closed in Q4. Mm-hmm. As a result, if you see our repeat revenue is at 86%, whereas normally it's at 90%, which I would take as a healthy sign. That is, our new logo engine is kicking in. And the good part is that many of these logos are already, or several of them are already at $1 million run rate. I think that's what has allowed us to deliver these results. And if you look at it from a geo perspective, Americas has clearly led the way. If you see again the percentage of revenue share from US, that's gone up, and the quarter-on-quarter growth has been quite impressive. The other geo that has done well for us is India. We continue to see good demand out there, and we had 3 new logo closures that contributed to the growth in demand. Middle East and Australia, the demand continues to be, I would say Middle East is much more vibrant. It's just that we saw a drop quarter on quarter because one of our large implementations came to an end during Q4, and that has resulted in a quarter on quarter effect. Europe is where we've seen a little bit of a lengthening of the sales cycle and decisions sort of getting pushed out, which has slowed down the growth in Europe. But overall, I think we had a good quarter from a revenue perspective.
So you mentioned about client mining or account mining, as well as new additions, especially in the Americas. So that is again in stark contrast to rest of the IT pack. What are you doing different in that sense?
I think there are 2-3 things that I would say that we are doing really well. Our land and expand strategy is something that has worked for us, and it continues to work for us because we are not looking for large deals per se. We're looking at how to break into an account, help a customer with a point need, on preferably a business problem or a newer technology, which they may not have as much capability in. So this allows us to break in where even large competitors are already present. And once we're able to prove ourselves, we're able to then do the implementation for that specific program. And from there, we're able to move into other business units. And this has really worked well for us. And in terms of, again, new logos, we've been very pointed in the kind of offerings that we are taking and to which vertical. So we're mapping offerings to verticals so that the intersection is much more finer rather than trying to do a little bit of a spraying of offerings or using the same offering across domains. I think that's, again, something that's helped us look a little different. And, where the pain point in the domain has resonated with offering, we've been able to start conversations and then take it forward from there. I'd say these 2 things have worked out well for us.
All right. Coming to you, Venkat, let's talk a bit of the numbers then. You clocked a margin in excess of 25%. Correct me if I'm wrong, for the 4th quarter in a row. Revenue is up, profit is up. How do you see the rest of the year panning out? Do you think you'll be able to maintain the margins at these levels? And what are the levers that you would bring in place? Say, for example, deal making suffers, and the conversations are that it's what we are having so far is that the conversion into revenue is not happening or is getting delayed. In that sense, what levers would you deploy to maintain your margins in excess of 25%?
So first, let me touch upon the revenue number. So
Yeah.
like Joseph mentioned, 4.7% rupee growth in total income. If you take the operating revenue growth, that's about 3.6% in constant currency. Coming from a slightly weaker quarter of 1.1% growth, the contrast is quite significant. The contrast becomes even more apparent and clear when you look at the entire IT industry. So yes, while I take that outlier comment that you made as a compliment,
Okay.
that has been basis the strengths that we have shown until now with regard to new customers and being able to mine existing customers. Coming to the new customer part, we signed up 17 in the last quarter, 18 in this quarter. If you look at the repeat business, that was 90% or 91% last quarter, compared to which is 86% this quarter, which means 14% of new business has happened, which essentially means the new logos that we have signed up, the new commits that we've got from customers are beginning to show traction and building into revenue streams for us. So that's something that I wanted to give you as a metric when comparing what's happening across the world. So 16% new business, contrasted with the macroeconomic environment and the spend reduction that people are talking about. Maybe we are doing some things right, like Joseph said, and that's helping our case a lot. Coming to margins, I delved so much on the revenue growth because margins effectively is a function of the revenue growth. So, are in a sort of a linear business. As revenue grows, your people cost goes up. You need to account for both, and the rest is your margins. So revenue growth is very important for us to defray any cost that you have in terms of people and account additions. You said 25% plus of EBITDA for 4 quarters, a small correction. It's a 13th quarter in succession that we have beaten the 25%.
All right.
And this is ahead of the guidance of 22 to 24% that we have held on to until now. So we have got a guidance of 22 to 24%, and we are doing 25% plus for 13 quarters in succession. While, yes, a lot of chest beating on that can be done, I'm very cognizant of the fact that we are going to see cost increases in terms of people cost increase happening in next quarter. We have to defray those cost increases through volume increases, which is the revenue growth that we have to show. And there has also been, the dollar rupee parity has always helped the Indian IT industry. So we hope to get something from there as well. But in short, 22 to 24 guidance, hope to beat it. The next quarter, there could be some adjustment in terms of EBITDA because of the wage cost increase that we are seeing. Otherwise, largely, your cost mix has been largely in line with revenues and in line with margin guidance that we have given.
All right. Next, on the similar lines, say for example, for future growth that we are talking about, Mr. Ashok Soota, the chairman, he has said that you are targeting $1 billion in revenue by 2031 at a CAGR of 25%. How do you plan to achieve those numbers, given the current environment and the evolving picture over the next, say, for 5 to 7 years, 8 years in the future?
So there are 2 elements to the revenue number and growth aspirations that we have talked about. One is the long-term goal, which is, like you said, $1 billion by 2031. And the second is the near-term goal of meeting a 25% revenue guidance for the current year. There are 2 elements. The longer-term goal of 25% growth to meet the $1 billion will be a collation of our organic growth and inorganic growth. So there has to be companies that we have to fold into our family to reach that number, because it's quite clear that your organic growth only takes you thus far.
Okay.
When you look at the current year, we said we'll do 25% revenue growth. We have not differentiated between organic and inorganic, because we have been clear that inorganic plays a significant role in touching that number. Now, if you look at how the current economic conditions are, we will need a little bit more support from the inorganic side to touch that number because of the way numbers are panned out across the world. We should, if you look at the number of 25%, yes, one could say maybe we should do better. But when you look at the peer set, when you look at the economic situation, I think we are doing, I don't want to say phenomenally well, but really well compared to what's out there in terms of comparison. So Suffice to say, this year we are pursuing M&A. We have got a decent or a very good pipeline, and those should have ideally we would have expected to close one at least in the first quarter or early second quarter. That has not happened, and some of these things you don't force them because it has to happen. It takes time because it's all about people business, and alignment is critical. So we are pursuing that with great gusto and energy, hopeful that we'll be able to close. If we are not able to close, we'll come back at the end of the second quarter, sometime in September, October timeframe, and tell the markets where we are looking at. But what does that mean? That means that our inorganic growth engine is going well. But what we thought we would be able to add through the inorganic part is not happening because of, this M&A tends to be binary. You can do all that you want, but signing, closing, and getting the deal on board has got so many moving parts to it.
You mentioned about your acquisitions. Obviously, they are delayed or something, but are there any particular gaps that you are looking to fill at the earliest? You are into IPs for IT services, product engineering, and infrastructure management. So any other new verticals that you're looking to expand into, or are you looking to plug some gaps in existing business?
Well, I'll hand over the second part of the question that you have to Joseph. The first thing that I would like to say is, in an acquisition, the question that one asks always is between build versus buy. So just to give you an example, today everybody is talking about Gen AI. We are also making quick inroads into that. We are hiring, we are training, putting together a team, hoping to scale that to 100 people, selling into existing customers. We are doing POCs, and we are doing quite a bit of that to do stuff. Now, the question is, do you wait to build it, or do you go out and buy it? So the skills that you talk about, if they're critical, if the competency that you need to build, or the business that you need to build is critical, one doesn't wait. We go ahead and start building, which is what we did with the low-code, no-code side of the business a couple of years back. And today we are at a decent size. The similar thing is happening in Gen AI. So when we go into the markets, look for companies, we're looking for companies which align with our business model at an overall level, and not maybe gaps to fill in. So from a vertical standpoint, I think, Joseph, you could add more.
Sure, Venkat. And as Venkat pointed out, Tushar, we're looking at companies that have a good growth trajectory, good profitability, because we're not looking at turnaround, and most importantly, the people match, so that integration is not a challenge. Is typically one of the main reasons why acquisitions fail. And we do have areas that we've identified in terms of subsegments in particular verticals where we could get a little bit more critical mass. We also have a few technologies where we would love to have more people both at senior and at an operating level available. And geos, if you look at SMI, one of the drivers for that acquisition, two drivers were healthcare expertise that we were getting, and also the fact that we're getting a center in Madurai. So that drove the decision. Apart from the fact that we very quickly realized that there was a huge culture match, and that's why the integration's gone off well. And we've already, working both ways with the people and opportunities getting pushed from both sides, and that happens only when there's a culture and people match. So that's what we would be looking at. How do we get these pockets of capabilities cutting across? It could be in healthcare, it could be in BFSI, not at a broad vertical level, but more at a subsegment or particular areas is what we would be looking at. But that would come as a follow through. The main thing is making sure that the company that we're looking at is the digital space. It's profitable, has growth trajectory, and there's a good culture and people match.
Got it. You mentioned, I'll expand on your last point about a good culture match and a people understanding in that sense. What are your hiring plans for the rest of the year? There was a net additions of 131. Your attrition is easing. So
yes,
in this current environment, given the demand that you're seeing, what are your hiring plans for the rest of the year?
Okay. So, at the beginning of the year, or even when we spoke last, we had mentioned that we're looking at hiring 1,300 people, of which 400 plus are going to come from campus. And as we speak, the first batch from the campus is joining us, or they'll be joining us sometime this week and over the next couple of weeks. Okay. The next set, that'll be around 200 and or so. The remaining will join later in the year. So that's one set of people, and you already have 130. There are two factors that are coming into play now. As you rightly mentioned, the attrition has eased up. If you see the attrition for Q1, it was around 13%, though our trailing 12 months is at 16.5 or 16.6%. Yeah. So the number of people that we need to hire will come down because of the attrition, which is a good problem to have. The second thing that we sort of, as a management team, decided is that we will take a little bit more of an agile and nimble approach to hiring to make sure that we're able to meet demand and supply, and also from a skill perspective, because if you hire in advance, then you're going to have, because the number of skills required is still, the plurality is still quite large. And so we don't want to overcommit in any area. So we will be quite deliberate and agile in the way we will be doing our recruitment as well.
Okay. One question to you, Joseph, again, and there'll be a final question to both of you. Joseph, what is the sort of deal making that you are seeing now? Is it discretionary focused or is it essential focused? If you can give some color on that.
Sure. So I would put into, I'll give 2 points over here, share 2 points to share. One is, most of the work that we do, and, the term discretionary is a little nebulous now, because do you call digital discretionary or not? I think it's become essential for all customers. I would say between run and new initiatives, right? And what we are seeing is that there is some optimization going on the existing infrastructure, application and run side to make money available or budget available for some of the newer initiatives, which are very essential for our customers to stay abreast of competition, right? From a market positioning and strategy perspective. The second thing we're seeing is that many of the initiatives are starting a little smaller, with either POCs or discoveries taking place to ensure that the kind of benefit that is expected is what they would actually get. And once that's proven, then you have budgets being allocated, and the budgets also get allocated in tranches, not as a whole program, which allows the customer also to have some flexibility on how they spend it, and also make the initiative more accountable for end results. And that's what we are seeing. So you start in over there, which has worked well to our advantage. As I said, we go in and do POCs or help customers with the initial discovery and consulting, and then get into implementation. That has worked well for us, and that's what we are seeing, at least in the customers and prospects that we are interacting with, Tushar.
Okay. So are you also witnessing a delay in the conversion of deals into revenue, as some other IT companies have actually complained about?
So we've seen some delays. I talked about Europe having a little bit of delays, and in any given year, you do have some initiatives or projects getting delayed. It's a little bit more maybe now, but that's something that we've sort of factored into our pipeline. So what you have to do is to make sure that your pipeline is that much larger than you would have otherwise had. And that's how we are addressing it. Increase your business development efforts. Venkat talked about the kind of revenues you're getting from new logos and the number of new logos. And that has become an important aspect of ensuring that, we continue to grow at the rate that we need to address any delays that we see in decision making.
All right. My final question, but I'll first get Venkat's views on this and then come back to you, Joseph.
Sure.
So we speak to a lot of analysts and everything. So some people say that FY24 will be a washout year for Indian IT. Somebody else said that it's a year of transition for Indian IT after the pandemic boom that happened in the last couple of years or 3 years. Where do you stand on this? How do you see the FY24 for you, as well as for the rest of the industry as well? What would you agree with? Is it a washout year, or is it a year of transition for Indian IT?
We have made a good start. That's the first thing I would like to say, and hopeful that we continue this pace going into the quarters and in fact build up a lot more steam. And like we said, if you are able to close a couple of those acquisitions, they can really add to the start that we have made this year. So talking about FY24, that's what I would like to say. But talking about the entire industry, I think there are these ups and downs which as the industry has always seen. And if you have noticed, the first industry to come out of it is also the Indian IT industry. So whether it is whether it is COVID, we are the first guys who have taken off, and that's because the agility that we have shown to keep ourselves all ahead of the curve. So today it is ChatGPT and generative AI. And as you can see, the IT industry is really working around the clock over time to make sure that they completely absorb what is happening around the world and getting prepared to do what is required by customers. So long as customers have needs, so long as the needs generate business, they are bringing in efficiency, IT is required. And so to that extent, I personally don't believe between this partition between discretionary spend and non-discretionary spend. Every IT is spent, and if there is an ROI, why would you not do it? So the moment there is an ROI, you want to do it. Maybe what could be missing is the fancy stuff that people are working on, which may know the payout will happen after many years. Those are the things which get postponed. But what is right now required here and now will drive this industry, and this may be at best a small correction, is what I would think, or just a resettlement, I would think, for the overall industry.
Joseph, your take.
I think it's similar to Venkat's take, Tushar. I look at it as a period. First of all, I think we had a period of very high and pent-up demand, and some of these things have to correct themselves, right? And that's what I think is happening right now. You're going through a little phase of correction and base effect. But having said that, I think some of the developments taking place around generative AI, about artificial intelligence as such, about data and the leverage that data gives you, and the central nature of technology in any of the strategic initiatives that customers are going to be implementing actually positions the Indian IT industry very well. And I think right now, many of them are building capabilities, are investing, and that's the right thing to do, I think. Build, look at the different trends out there, recalibrate your strategy, build the capabilities and skills required to execute on them, and be ready, because this is a phase, and all of us have been through 2 or 3 of these already. I can remember 2000, everybody thought it's the end of the world. 2008 looked even worse. And 2020 was fleeting, actually, fortunately for all of us. There should be many more opportunities coming up, just because the central nature of technology to whatever you want to do. I mean, every industry is run on technology now, right? And I think that is very promising, and we are quite excited out here.
All right. Thank you, Joseph, for those comments. Thank you, Venkat, for joining us. Thank you, gentlemen, for joining us after the first quarter results. I hope the future is very bright for you guys. Thank you, viewers, for joining in. This is Tushar for BQ Prime.
Thank you.
Thank you. All the best to BQ Prime and you, Tushar.
Thank you. Yeah, bye-bye.
Thank you. Thank you.